Okay, looks like I got some vocal here. All right, folks. This is going to be This is going to be Exam 1, Part 2 key. Over here, I have the instructions. Okay, and I'd had those there ever since the class started. I said you're going to use the file for XLS6, which is Badger Jams. It's from case 6 of the solid text. And assume the following changes from the base. So we had done this case. You remember we did this when we you remember we did the break-even analysis and all that business. Okay. So what we're going to do this time is you remember we've been talking about developing scenarios. So we're going to kind of do a scenario here. And I want you to compute the selling price required to keep break-even units at 1,147 units. So, okay, and I want you to document your work by uploading an XLS file that documents what you did. I said it's permissible to upload a case file for XLS6 that we review in class or that is due. It's Badger Jam. So we're going to have to make some changes. So I'm going to go ahead and highlight that so in the middle of this word problem, okay, we don't get too whacked out on it. Okay. So the first thing I'm going to do is I'm going to, the rent will be 5, it's going to go 5.3%. So this is going to equal, and you can see I've done it here. And you can see, and I'll go ahead and I'll copy this out of the formula bar and put it into down here. The rent now will become and I'll escape that. 12,000 times 1.053. And so the new rent figure is 12,636. Okay? The advertising, I said was going to go up 2.91%, so we took the advertising figure at 5550 times 1.0291, and that gave us the new advertising figure. Commercial stove, the cost of it went up 6.8%. So I took 7,200 times, the commercial stove went down 6.8%. It was reduced. And so we took 7,200 times 1 minus 0.068, and that gave us 6710. And then the cooking equipment went up 3.2%. You can see that up here in the formula bar. Okay. And then and that gave us, and then the shipping costs down the variable cost went up 12%. You'll notice I have 1.95 times 1.12. So we had those new figures, and then we had to figure out, okay, what's the selling price to get us to break-even units? And so the selling price, okay, just would be a simple and you could just simply go through to get us to 1,147 units. And remember, the selling price was originally $39, okay, and $39.95. That was the original price. So let's try, and then it just became an issue. You could use the goal seek to get the sale price, or you could just start entering sales prices in there to get yourself to the break even of 1,147 units. Okay, and here's the break even, which is 1 times the break even units. Okay, and then the revenue is D28 times the sales price. And you could have used goal seek to get this figure. And I'll just play with this just for a moment to show you what you could do. We had the original price of $39.95. So let's say we make it, let's say we make it 39.98. Let's see what that does. Break-even units? Nope, we're at 1173. Okay, I could try it at $40 even. Nope, I'm at 1172. So you'll notice as I keep coming down, all right, now the break-even units is equal to the total fixed cost divided by the contribution margin. So you could have come in and just simply said, all right, what do I need in terms of a contribution margin, okay, to get up to 1147. And so we did 40, and then I'm going to try 41. All right, now that's 1122. I'm going to try 42. That's 1075. That's fewer, so I'm going to come back to 41. I'm going to try 4150. I'm just playing around with it, kind of doing a goal seek, if you will. And that's 1098. So I'm going to come down back to $40. And I'm at 1172. So I'm going to try to come down a little bit more here, okay, in terms of, let's see, I'm going to have 1172. So I'm going to call it $40.50. And I'm close. So if you got this close to 1146, I'm good. Okay. So if you're around $40.50, I'm good now. I've got this file saved, so I'm just going to walk back the changes I made where I'd done all that work. Got myself to 1,147 units, and I have to charge $40.49. Actually, it's this exact figure here. So if you were close, $40.50, $40.49 or something like that, I'm good. And that's how you do it, okay? That's exam 2, exam 1, part 2 key. And so all we did here is what I've said all along. We do some changes. Okay, you say, could I put this into a scenario manager and go ahead and do it like that? Yes, you could. Wouldn't be a problem at all if you did so. In fact, it might be smart, but again, you could also have used goal seek to get to the 1147. And let's say, and I'm gonna do this. I'm gonna put the sales price at $39. Okay. And let's try it with goal seek. So I'm going to click on data, and then okay. I'll click on data. Now I'm going to do what if analysis. I'm going to do goal seek. Now I put set sell. Okay, that's the units sold, D28 to. I want to get back to 1147. I think that was the break even units by changing cell B8 and see what it does for us. And there we be. And it gave us $40.49. Now, if I click up here, of course, it gives it all the way out there, but take 40. So it's $40.49 if you came up with $40.50. I'm good to go there. Okay, so that's all that's really had to do. Now, this key, all right, I've got it, and I'm going to do this. I'll close this. I'm going to save it as the Badger Jams key. Fall 2017. I'm going to put it here on my desktop. I'm going to save it. Okay. I'm going to close this off. And then I'm going to upload the file. And it will be over here in the files area for you to see. So I'll upload it and find this. And I'll find the exam 2, exam 1, part 2 key, fall 2017, and I'll upload the file, and it's there for you to see. It's over in the files section. So you should have $40.49 or $40.50. I'm good either one of those. I won't split that many hairs with you. So it'll be interesting to see how everybody does. Now, in order to go ahead and get us to the full 150 minutes of instructional time that we're supposed to have, this will be part 2 when I save this file, is I want to take a look at case 11. Okay, we had looked at spreadsheet case number 10 last night, and we categorized all those receivables. That was spreadsheet case 10, Blue Sky Computer Services, and we used the SUMIF function. We used the vertical lookup function. Okay, so we used some database functions in Excel. And as I've said, the holy grail for all these computer companies is to come up with a one tool that gives you all the advantages you have with a database and all of the analytic or spreadsheet or number crunching capability of an Excel. And there are some out there. One would be a product that's called Tableau, and you'll want to maybe go out and take a look at it. But I want to move us on to case number 11. And this is Morgan Wagner Machinery. That's case 11, and it's in the Solvent book, 103, page 103. And I also want to make sure, I don't know if I mentioned or not, but I was kind of panicky last night because I looked at some of the grades and early on I thought, uh-oh, not good. Well, as I looked at everybody's grades, I had a lot of you who made a perfect score, and so I'm not going to curve the grades, okay? Now, you say, oh, I didn't do well, what do I do? Well, here's something I always do in this course, I'm going to do anyway. If you can identify my favorite function in Excel, my favorite function, send me an email and tell me what it is. I will neither confirm nor deny it, but if you get it right, you'll get a bonus of 25 points. But you have to send me an email and let me know. My favorite function in Excel, okay? And there's about 200 of them, but I guarantee you, you'll know it when you see it. All right, now let's look at spreadsheet case number 11. It's page 103. It's Morgan Wagner Machinery, and as usual, the authors tell us about their in Decatur, Illinois. They make bearings and metal parts for farm machinery. Okay, they're manufacturers, and they've bought a numerically controlled machine. Actually, it's called a computer numerically controlled machine, CNC tool. And basically, this machine, it does some kind of cutting or punching holes for screws and bolts, whatever. The first CNC I ever saw was back in the early '80s, and this was at a company that was Hager Pants. It was Hager Pants had a plant down in Cape Girardeau, Missouri. I was teaching at Southeast Missouri State University, and I went over, and it was amazing because this CNC would do the cut for it would do the cut for the inseam of the pants, okay, and they did that cut so they could sew it back and put the little top on it, or that little kind of. We have a pair of jeans. Yeah, some of them will have kind of a top to them, or I can't. I'm not sure I'm describing it correctly, but the CNC would do the cut, okay, and then they'd take it and they'd run the pant, and they had another CNC that would do the sewing. Now, it used to be people did those cuts that worked in the garment industry. So this is kind of near and dear to my heart. And they were talking about, and this is a case about capital expenditures, okay? Now, here on page 103, they give us some information. They're going to spend $640,000 for this new machine. They estimate that the firm's after-tax income, okay, will go up by $1,300 each year over 5 years because they're going to reduce production costs. At the end of the 6 years, they think they can sell the machine at auction as a used machine. In other words, it's salvage, and the sales price at the end of the total life will be $210,000. Now, what we're dealing with, and the text talks about this in the middle of page 103, is a capital expenditure. And a capital expenditure is any expenditure that will go over more than one fiscal period, annual fiscal period. Now, when we look at a capital budget, or we look at a project, if the return on that project is not at least equal to or greater than what the owners or investors could get if they put their money in a project of similar risk, then you don't do the project. And so this case is about dealing with that. And one of the ways you do that is we look at what we call the net present value method. And we're going to do net present value. Okay, so this is case 11, Morgan Wagner. Now, I'm over here in the files, all right, and I'm going to see if I can find XLS11, and it'll be done. And we'll pop it up here and take a look at it. Now, I worked on this last night, and I had Thursday nights, I had a technical glitch, so I had to stop. You know, my computer froze. So I had to stop and redo it. Now here's XLS11 done. That's the case. Okay. And I'm going to download it to my desktop. All right. And this is the finished product. And what we're going to do is we're going to use the third what if tool in the data what if analysis. Remember, we click on data and we come over here as what if analysis. Now, we just got through working on, we've used GoalSeek a few times. Scenario Manager, we've worked with it. And now we're going to use the data table. Okay? The data table concept is pretty simple. What it does is it lets us look at the effects of two variables, okay? In this case, we're looking at the effect of interest rate, or what people call the discount rate, versus the annual cash flow, okay? Now, intuitively, it's easy to understand that about interest. I've invested $100, I earned 6%. At the end of the year, I have $106. At the end of the second year, I have $106 times 1.06, on and on. What's intuitively not easy to understand is the discount rate. Money has a time value. Let's say you have $100 today, and you could buy a certain set of goods or services with that $100. If you have 2% inflation, then next year, the $100 that you have will only buy you $98 worth of goods and services. It's a thing called inflation. So we have to take that into account. And so we want to know, if I do this capital project and it runs out 6 years, what am I going to get in return? What is it worth in today's dollars? Okay. Now, firms will come up with what they call an interest rate, i.e., a discount rate. When you study finance, you'll go learn about a thing called the weighted average cost of capital. And firms know how much it costs them. There are three sources for a company. Stock, they issue some stock, they borrow some money, or they make a profit and they plow that money back, and that's called retained earnings. Okay. Which one of it is the most expensive? It depends on the life of the company and where they're at. For some companies, it's retained earnings is very expensive. For others, the more expensive is debt. For others, the more expensive is stock. It just depends. That's why you'll study the weighted average cost of capital, but it doesn't stay the same. Now, in this case, the company has said they've got to earn 10% to justify the project. Okay? This is also known as the hurdle rate. And when companies engage in capital budgeting, okay, they often have competing projects. Now, if they have plenty of money to fund everything, then then you're just looking at, okay, well, we'll fund this. But if they have limited resources, which virtually every company does except Google, then the bottom line is you have to decide. And so you use this interest rate to kind of wash everything out. Now, you'll see right here that we have the typical stuff in our spreadsheet. We have the documentation area. It's up here. I'm going to highlight that for you. Then we have the assumptions area. In fact, amazingly, I labeled it that. And here are the key assumptions. Our interest rate is 10%. Salvage value is $210,000. We may even have someone who has signed a contract to buy the thing at the end of 6 years for $210,000. You say, why would somebody do that? Because the cost of a brand new machine is $640,000, and you say, I'll wait. Okay. Now the good news for Morgan Wagner Machinery is that while they buy this equipment, they can also take the depreciation on that equipment. Depreciation is how you account for the expenses incurred of using an asset, and so they get, and then that comes off your taxes. Is this a great country or what? So the salvage value of that machine will be $210,000. Then you look at the annual income from the investment. We're going to save $130,000 a year. Now we've done the assumptions. Now we build what we call the timeline. And here's our capital budgeting analysis. Now I'm going to add one thing in here. I'm going to put in the period, okay? And this is the startup, so this would be period 0. This will be period 1. This will be period 2. It's going to be period 3. This will be period 4. And this will be period 5. You say, wait a minute, it's a 6-month project. Yes, it is, but we started at 0. So we have 1, 2, 3, 4, 5, 6 years. Now we have those years expressed down here in their date. But I always like to do this so I kind of get a feeling of what I'm really up against. Okay? So we have 5 years. Period 0 is also known as the startup or the sunk cost period. You say, what do you mean? If we buy the machine and we don't make any money from it, we have a sunk cost of $640,000. Just like when we looked at Badger Jams, that entrepreneur had a sunk cost of $25,700 plus $64,000 to live on for that year. So in this case, our cost of our investment is $640,000. We got to pay that to get the machine so we can realize the benefits. Now we start to look at the annual savings from this investment. We're saving in production costs. And that's probably going to be a combination of things that we're going to do: reduce some labor, we're going to reduce some wasted material, etc. And you can see that this is constructed like an annuity. The authors did this to make this a little bit easier. In truth, capital budgets typically will have a annual income very, very low in period 0. Then period 1, it'll build. Period 2, it builds some more. Period 3, and then right around period 5 or period 6, it levels off, and we get them what we call a terminal value. We just assume it's going to kind of stay about the same. Here, the authors have made it easy by using an annuity. An annuity is a very simple concept. It's a fixed amount of money, okay, over a fixed amount of time at a fixed rate of interest. Okay, so this whole idea of discounting is important, and this interest rate, this is really properly called the discount rate, but we'll be okay with that. So we've got 130,000 a year. We buy the equipment, we pay $640, then we start to see the benefit. Now, for each period, we want to compute the annual net cash flow. And the annual net cash flow is going to be annual income less any expenses. Now, we've already figured in the net income. So and that's 130,000. And that's there in the textbook, page 103. So, are there any other? So we have the net income. And is there anything else that we'll have to spend? Well, we'll have to spend. We won't have any other expenditures, okay? Because the 130,000 is a net. So we've taken out the cost, okay, from the additional revenue, the annual income we get. The annual income implies that there's taxes and so forth taken out. Now, depreciation, back in for just a minute. Depreciation is one of the greatest friends a business person can ever have, because depreciation, while in truth it accounts for the use of an asset, it's also what we now call a non-cash expense. Is this a great country or what? Isn't it good to be a capitalist? You buy a piece of equipment, the government lets you write off the cost of it, and you make money or save money. But that's why it's called. That's why we try to have tax. We try to provide incentives for businesses to invest. Okay, and so you're going to hear arguments from the politicians about we ought to cut personal income tax. You're going to have other people say we ought to cut the capital gains tax. Others will say we ought to cut the inheritance tax. Okay, well, you know, I know this. If you give businesses a greater depreciation level, and there are tax tables that will say based on the certain type of equipment and its use life, but here's how much it's worth. And there are tables that help you calculate that. For my own opinion, if you really want to help pump the economy, give the tax break on depreciation. Okay? Let them depreciate more, and they'll buy more equipment. And if they buy more equipment, they'll be more productive. It's that simple. Okay? Now, giving individual income consumers, let's say you tell everybody, okay, we're going to give you, we're Washington, we love you, God bless America, and we're going to cut them taxes. So we're going to give you a tax cut of X percentage. Now, usually the way this works is that the average human being like you and me might get a few thousand, we might get a few $100 at most. But then the people who are millionaires and billionaires, they get thousands or tens of thousands of dollars in a tax cut. If you're making $500 million a year, $10,000 it's chump change. If you're making $100,000 a year, $10,000 is a serious proposition, and if you're making $50,000 a year, $10,000 a year could kill you or put you in heaven, one of the two. Enough of that. You'll learn about depreciation, all those kinds of good things when you take accounting 1. We got the annual income for the investment, and then we have the annual cash flow. So we want to know, what's our annual cash flow? Now, as I've said before, when we did, cash is like inventory. I know you've listened to Dave Ramsey and people tell you debt is bad. I'm here to tell you, no, debt's not bad. It's the misuse of debt that's bad. That's when it's bad Christian, slap hand, bad Christian. The proper use of debt is smart. Now, you can go out on the internet and find out for yourself and go and find the advantages of trade credit. If you borrow money, let's say that you have someone who says, here's the terms for trade credit. Net 10, 220. If you pay the 10% within 20 days, you get, if you pay the net 10, you get 2% off your bill. So you want to look at those. And that is because people say if you're paying me early, okay. Now, let me tell you about some stupidity that's out there, okay? Now, if you don't believe that, that most people are numerically challenged, look around you at all the casinos that exist. Because casinos are places for people who are numerically stupid. That's the only way to describe it. You will not beat the house. You might hit a jackpot. You might make $1 million. I guarantee you, in the long run, you will not win. Those games are designed for you not to win. So, I've said my piece. So, we've got the annual net cash flow of $130,000. And we've got that figured for each year. And I want you to notice something as I've constructed this. I have the assumption areas, and then when I come down here into the calculation and output area, I start using cell references. That's because we're going to tie these into the table. If you went to use this and solve this problem and you don't chain the references using cell references, the data table won't work. Okay? It just won't. So now we've got the annual income, annual net cash flow, excuse me. Then we say, okay, well, what is that over the 6 years? Well, there it is. Then we say, okay, what's the net present value? What is that worth in today's money? And we use the NPV. It's not as fearsome as you think. Don't confuse it. And don't confuse it with MVP. That's most valuable player. This is net present value. What's that money worth? Let's look at this for just a minute. Over the 6-year period, they're going to get an annual cash flow, okay, of $990,000. But that $990,000 has a time value, and it's not worth that much later on. So we're going to test it, and we use our rate, which is 10%. Then we have a value or set of values, and we entered in B21 to G21, and that is the annual net cash flow. Now, if you wanted to put in, if you wanted to put in B1, C1, you can do value 1, value 2. If you want to do that, fine. Otherwise, use the cell reference. I think you're smart enough and you've seen enough of this to do that. Okay. So we've got the rate, we've got the values inputted, and here we see our result. That $990,000 is only really actually worth $684,000 in today's money. So now you can put into perspective what you're going to cough up right now, the 640. So we get the net present value of the investment by taking 684, that's the present value, less the cost of the investment. And so we're going to spend $640,000 to make $44,000. And you say, that's not fair. Life isn't fair, my friends. And business is not for scaredy cats or dummies. It's a challenge. So we have a thing, we say, okay, well, how do I put this in perspective? We're back to our friend, the ratio. That takes our dirty, filthy data and scrubs it up. So I'm going to go here with profitability index, which is B24 over B25, and that is the present value divided by the cost of the investment. And so what it shows is I'm making about 7%. Now, should I operate this project based on the assumptions? I wouldn't, because I'm making 7% profit when I really need to be making 10% or more. Now, I might say this is a strategically important project. I might say I think the cash flows, I might say I'm going to state the cash annual income on a very conservative basis. Okay, you could do that. You could use our friend the rand between if you want. Let's do that for just a minute. So I'm going to put equal rand between. And let's click on the FX. So equal rand between. And we need a bottom value. And let's say, worst case scenario, we're about 30% off. So let's say that we're going to do 100,000. We overestimated by 30,000 a year. And the top, we'll do 160,000. Got it? Now, we can do this out over, that would be simulation. Now what we're doing is we're doing a simulation right now. Okay? And so we get these set of numbers. Now this is volatile because it uses a random function in Excel, which is volatile. But instead of the 130, I could simulate this, okay, and use the mean, I could use the mean from this, or a mode if there is one, or a median. I think the median would probably be your best bet because it's the number that's in the middle. I just wanted to show you that, to say we can simulate these figures. And if you're a really good company, the 130 grand a year, you've already worked through that. Okay. Well, now we're ready to come down here and build the data table. Let's start at the hinge, okay, or the corner of the table. It's down here in B33. And inside, and notice here I use that, I'm continuing to use the cell referencing. And I put it equals B27. So there's the cell, the format of cell reference, there's the actual data. Now up top here, okay, I have interest rates running from 7% all the way up to 13%. You say, oh, so you went 3% lower and 3% higher. Yeah, why not? Okay. Now, below here, I have the annual income. And I said, okay, I'm thinking that it's going to be somewhere between 100,000 a year and 160,000 a year. You say, oh, 30,000 less than what you think, 30,000 more. Yeah. Okay. And there they are. Now we use the data table function. Click it in here, and you're going to see it says it's going to have a bracket equal table, which is the table function. B10, B12. Okay. Now, let's look at this for just a moment. And I'm going to click on the FX and see if it can give me a dialog box. It's not going to now. The data table in here, let's look at this, B10. Now let's see if it'll give me the dialog box. There it is. Well, no, it's not giving me that. Okay, look. We use the equal, and we insert the data table. We'll just do this. We do the data, click on the what if analysis, and click data table. This will give us the dialog box. And it says in the dialog box, what is the row input cell? What is the column input cell? Okay? And in this case, all right, we're looking at the interaction of annual income, that's on the vertical axis, and then with various interest rates or capital hurdle rates. Okay, now the row input is B10, which is the interest rate. Okay, so think of this like we're finding intersections, and everything, the row input cell is the interest rate. You say, wait a minute, the row, well, they run in a row. Then we're going to intersect them with the column input cell, okay? And that's going to be B12, which is the annual additional income. I'll cancel this for a minute. You put your key in here, and there it is. Now it treats this like a true formal function because it shows the brackets. Okay? And I've already done it for you. Now the way to check your work is very simple. Come down to the interest rate that you said, which is 10%. Okay? Then scroll down to the income you thought you'd earn. And if you, let's magnify this thing up. Okay? And at 10%, 130,000 a year, we get a profitability index of 1.0699. We're in good shape. Now, we add some visual acuity to this by using a conditional formatting. Now, I'm going to click in here, and to find out how I did this, I'm going to click on conditional formatting, and I'm going to click manage the rules. This will show me the rules, and what I have is a color gradient scale. And what I've done is I use a red to green. Green is good, yellow, and red is bad, bad, bad. Let's look at the, and it also gives us a very beautiful rainbow. Isn't that nice? So I've rained on your parade by making you watch yet another video, but there's a rainbow in this case. Isn't that nice? Now, you'll notice as the interest rate goes up, okay, the profitability index goes down. Even at the highest monthly income. And how could I improve it? Let's just do this. On the side, let's put annual income. So we're sure there's no question what we're working with there. And then above here, we'll put interest rate. Okay, so it's clear who's what. And this is kind of a hinge. And so as you see the way these colors flow, you can see that the lower the annual income, the lower the profitability index. The higher the annual income, the higher higher the profitability index. So this lets you look at the dynamics and lets you kind of see. And you say, that sure looks like a weather map. Yes, I've said this many, many times. This conditional formatting, okay, is a thermal. We call it a thermal because it works in gradients of color, just like you get a thermal when you get a map, okay, and no different. So we know, okay, where we sit in terms of our profitability index, and we know that, you know, and again, all of this is about making a decision. Now, if we're going strictly by the numbers, we won't do this project for a simple reason. It doesn't reach a 10% return. It only does that if we're making $160,000 a year. Okay? Now, and that gets us a higher return. Okay, if I come up and let's say I'm at 160,000, and I'm going to assume 10%. It's 160,000 a year. We have a 1.274, so we're making 27% profit. We like it. At 10% interest rate, 150,000 a year, we're making 18%. We like it. At 140 grand a year, we make 14% profit. We like it. Then when we drop down to 130, bad news. So we know where we need to be given that 10% interest rate, which means we're going to have to get more annual income. So we wouldn't do this capital project. Now, there's also a business or a strategic consideration, and that is we want to do this because we're going to automate things. And we might say, okay, if I automate this process, I can make a whole lot of stuff, and I can cut some prices. Or with this numerically controlled machine, I can make some really pretty stuff and sell it at a premium. Or I could just simply say, we want to keep up, okay, and it's not 10%, but 7% we can live with because we have some other projects here that will get us 13 or 14%, so it'll all kind of even out. So those are the kinds of conversations that will go on. And that, my friends, is XLS 11 done. Okay? Now, I want to diminish this for a moment and make sure you understand. This is published. It's there for you to see. And my friends, it is there for you to upload, just like XLS 10. Okay, is there for here it is. Here's 10, XLS 10, September 21, 2017. That's what you upload for XLS 10, and then I showed you what you upload for XLS 11. Isn't that nice? So that takes care of our time for this week. I've gone over exam 1, part 1, exam 1, part 2, and we looked at case 10, which you need to upload, and we looked at case 11, which you need to upload. So what do we got left? Well, we've got trim and assembly, which is spreadsheet case 12, okay? And then we have Pacific Trading. That's on page 119. Now look, there's an error in the book. On page 119, Pacific Trading, they mark it as spreadsheet case 12. It's actually 13. And on that one, we're going to use pivot tables. Okay? on the tutorial or trim and assembly, we're going to make some macaronis, some macros. So we have an exciting thing coming up. And so by next week, we will leave Excel behind triumphantly, and we're going to head into working with databases. And now you'll understand as we start to work with the databases. And I know some of you have never worked with a database, maybe you've worked a little with Access. Don't worry, we will take it slow and easy so that you will not, there will be no child left behind, which I think is a wonderful thing to know. Okay, my friends, I will see you next Thursday. Have a good one, and I'll be grading and posting grades. You already know your grade for the for exam 1. That should show up. Now remember though, on exam 1 part 1, exam 1 part 2, I have to look at those, and the correct answer was $40.49 or $40.50. I'll take either one. What's a penny, my friends? Okay. Have a good weekend. Thanks a lot, and keep up the good work. I'm going to stop the share, and I'll stop the recording and end the meeting.